Alright, today here we have an investing portfolio sent in by a viewer of the channel, and I have to tell you, this is one of the most exciting things I've seen in a long time. To cut to the chase, to make this story short, this is an investing portfolio that had home run bets starting in either 2018, 2019, and also April of 2020 last year on two things: crypto and also economic reopening after the coronavirus. And I have to say, this is one of the most insane joyride portfolios I've seen. So just starting off here, this is a $120,000 portfolio. And I can tell you, based on what I'm seeing in this portfolio, it did not start out this way. This person would not be worth more than $120,000 in their side investing portfolio for fun if they had not taken these strategies. Is this portfolio perfect? No, absolutely not. But there are many huge wins in this portfolio that you can use and possibly take into consideration when you're adapting your own strategies. Let's take a look. So if this person had never invested in the first place, they would be down. They would be short $42,000. And so backing into that math, we can actually find out how much they invested in the first place. Alright, so this person, obviously over time through contributions, not just obviously starting out with exactly $78,000 they contributed likely over time, this person turned 78 grand into over $120,000, and really it looks like just about a year or less. We're talking an overall gain of 53%, right? So tracking here is the S&P 500 in that time. You can see they really had to eat low growth there for a long period of time, looks about 6 to 9 months during the summer. But they won big right after the initial coronavirus pandemic bailout, and now also to this recent cryptocurrency surge. So it's really quite incredible. Yahoo Finance labels this portfolio as moderately aggressive, and I would definitely go further than that. Moderately aggressive is way too simple of an explanation for what's going on in this portfolio to me is almost insanity. But finally too, it tries to break this down into categories. This isn't perfect, right? So it says there's 27% in financial services, 33% in energy, a little bit in basic materials, a little bit in real estate, industrials, and consumer cyclicals. But really the big category is others, right? So I did some math here. And based on the portfolio, I'm looking adding everything up. Almost half of this entire portfolio is in cryptocurrency. There's stock about a little bit less than half from that, and then commodities are the last wedge that make that up. And so the cryptocurrency tab, even of itself, is really interesting. So it's not just straight cryptocurrency. I'm gonna have to explain that further. This portfolio from the subscriber has holdings in Ethereum, Bitcoin, Litecoin, and also a company not many people are talking about, which is Argo. Oh, what's that? I know what a fair value is, Yahoo Finance. You don't have to tell me. Is Argo Blockchain PLC. Now, this is an OTC stock because I believe it's foreign. Yeah, it's based in London. In fact, there's only 7 employees. So this is a kind of a weird, strange Bitcoin mining. Bitcoin and cryptocurrency mining operation. And as far as I know, they keep their mining operations in Canada, possibly to benefit from the lower temperatures. It's headquartered in London and on the OTC stock exchange. And this portfolio, if we're going to change by market value, is holding $30,000 at an almost 9% loss. Oh, $30,000 in Argo blockchain. So, whoa, I gotta tell you, that's making my heart race a little bit. How almost, let's see. I mean, in general, half of your portfolio is in cryptocurrency, almost half, right? But then on top of that, concentrated in one OTC stock. So you've got a quarter of your portfolio in Argo blockchain. And the market cap's only a little bit over $1 billion. This company also hasn't been around for a long time. It's been pretty flat. Now, I give you credit for diversifying, right? Because many people just simply buy cryptocurrency and that's the end of it, right? So they would do something similar to this, maybe even a little less than you. You took an interesting approach where not only are you exposing yourself to mining and holding cryptocurrency, but you're buying the straight currencies and holding them either from exchanges or outside of exchanges. And that really is interesting. That said though, overall, half of your portfolio is now crypto. It's a double-edged sword because cryptocurrency, just being honest, made your portfolio, right? Cryptocurrency made you. So a combination between Ethereum, Bitcoin, Litecoin, you're talking about a 2,000% gain, 600, 200% gain. So you're talking thousands of dollars, right? And that's great. Bitcoin made you, but Bitcoin is also what continues to make this portfolio still so risky. Now with Ethereum, we know who the creator of Ethereum is. It's a guy in Russia. His name escapes me. It's not particularly important. We know the people behind the Ethereum network, who's monitoring it. They have obviously ties to different countries. We know the developer team. Bitcoin is interesting, right? Because Bitcoin is, pardon the expression, Bitcoin has always been the gold standard, but I hate to say this, and this has always made me a little nervous about Bitcoin, is we still don't know who Satoshi Nakamoto is. And Satoshi Nakamoto, as far as I'm aware, still controls a huge portion of the Bitcoin supply. That makes me nervous. That makes me really nervous. So, holding $17,000 in Bitcoin, I don't know about that. Then at the same time too though, Bitcoin made you. So that's a choice ultimately you have to make up to you. I know there are a lot of people who are more in the ETF side of investing who would shudder to think that someone has 44% of their portfolio into cryptocurrency, but if it made you, you do you. There's not much for me to intervene on this portfolio just based on the fact that you've done so insanely well. I mean, I have to admit, out of everyone I know, you played the opening the best. Not just the initial bailout after the coronavirus pandemic, you played the recovery from the coronavirus pandemic better than anyone I know in my personal life. That said, there's a degree of luck in here, right? So your Ethereum holdings would not have exploded this much, even outpacing Bitcoin, if the non-fungible token phenomenon had not taken off. And so what's happening is that Ethereum and NFTs, non-fungible tokens, have allowed artists to actually sell their work in a way that's never been seen before. And that really has helped the price of Ethereum, a network that's more capable of this versus Bitcoin. And as a result, you've done very, very well. And the great thing about this too is that I think, frankly, just based on how NFTs are, I think it's less likely to get severely regulated as, normal traditional cryptocurrencies are, because a normal cryptocurrency is trying to straight up replace the fiat government money from different countries. And there's obviously an incentive from different governments to just shut it down or introduce their own alternatives. With Ethereum, if it's only going into the art world, I think it likely will be regulated, but not as significantly as something like Bitcoin would be. So for example, Bitcoin, as far as I'm aware, is banned in China and India. So that's very interesting. You made it big with Ethereum. You got really, really well positioned for that NFT boom, as I know you got into just based on the portfolio you sent me. You got into Ethereum, I think, in 2018, 2019. And yeah, the person who sent me in their portfolio really hit a home run on cryptocurrency. Skipping ahead now to performance over the last year, there was a brief period where obviously the S&P 500, at least this year and also last year, was matching you, but particularly with that NFT boom, you've really, really just outrun the S&P 500. We're talking 300% gains here versus 63% for the S&P 500. Again, sorting by market value, one thing this portfolio did really well is you played restaurant reopenings and also energy reopenings and the energy rebound really well into your portfolio. So you have here Crestwood Equity Partners LP. This is obviously infrastructure, natural gas, crude oil. It's a domestic energy play. Revenues have been falling, but you managed to catch it, it looks like, when it was severely undervalued, paying you almost a 9% dividend. You've done an excellent job on this. I'm still worried about this company overall, because if you remember, before the coronavirus pandemic, this was not a good place to be. It just wasn't doing well. Domestic U.S. production of energy just hasn't done well, particularly the past, looks like 8 years or so. But you played the coronavirus and energy bailout and energy rebound afterwards very well. It makes me nervous that you're holding now, again, similarly almost 30% of your portfolio in this energy play, but you're sitting on big gains and collecting on a dividend, so it's up to you. Your cost basis is quite good. You could also sell options on top of that if you want to get more income. It's really interesting. One thing I want to emphasize with this portfolio too is that it is heavy on three things actually. Cryptocurrency, economy rebound after the coronavirus pandemic, and inflation hedging. This is one of the most interesting, almost Frankenstein portfolios I've seen now. So you have here is a farmland REIT, Gladstone Land Corporation. This is one thing I want to make a video about, and I haven't got a chance to make a video about it yet. I'm waiting for some more crucial information to become available. But this company just ran away during the coronavirus. It never really dipped. It never dipped. And year to date, it's up. It's up a ton. Let's see how much is up. It's up nearly 50% since the coronavirus pandemic while paying a dividend the entire time. So you've done an excellent job on that. It looks like it's generated returns for you, it's giving you a dividend, and also seeing that it's farmland, that it's an excellent inflation hedge. And this is a good size of your portfolio too. You've got silver in here too. It's funny that you've picked silver as a greater commodity play than gold, $5,000 to $3,000, because the information is now in. We know, just based on people trying to track inflation, that ironically, and this is really interesting, even silver on the ETFs, paper silver, is up 38%, and gold is down 3%. You got one of the best inflation hedges, right? So look at these returns. So the best thing was steel and lumber. That's really big for innovation. They've done well on the infrastructure package. They've done well for people staying home, renovating their houses. Oil has done extremely well this past year. These statistics, by the way, are all since April of 2020. You've done very well because for some reason, without even knowing, picking blind last year, you picked some of the top winners of the inflation surges of the past year. So you got big into oil. That's up 80%. That's the number 3 winner of the past year. Then you got big into farmland, which is obviously agricultural. We're talking soybeans, corn, cotton, wheat. You've done well. And then gold versus silver. Gold's actually been down 3% the last year. You picked silver and outweighed it compared to gold, and it did extremely well. It's up 38%, which is better than cotton, coffee, and wheat, even just the food index broadly. Bitcoin. You did well. You did well in cryptocurrency. Props to you. You beat out the stock market handily, easily. Most people can't say that. Most people have been all in on Tesla, and Tesla these days is more or less pacing with the S&P 500. This really is an incredible portfolio. Particularly too, this REIT, Gladstone Land, is pretty highly leveraged, and guess what does well during times of inflation? It's debt, because your debt gets wiped out by currency inflation, and this has been a really interesting play, so congratulations to you for that. The rest of these aren't really worth a full investigation because you have a play here for Ruth's Chris, which is a steakhouse. And I'm guessing, and by the way, congratulations on that 40% return, even still. I'm guessing this is from the coronavirus reopening play. You took these positions looking at your portfolio when the economy was shutting down and just before the coronavirus bailout. And you probably bet that chain restaurants, big chains would benefit from all the mom and pop restaurants shutting down because they would have the access to capital and access to financing that could keep them alive through a lockdown. And you were right. Despite the fact that Ruth's Chris wasn't making a ton of money, it was just dominating and eating up the market share from all the mom and pops that were shutting down. And so when the coronavirus shutdowns finally ended and restaurants finally reopened, you did really well. That was a great pick. You know, there's so many people who picked just consumer goods generally, trying to bet on a rebound, trying to bet on an end to the lockdowns. But in this portfolio, you made some really excellent targeted investments. Bloomin' Brands is another example of the same thing. One thing is really interesting. So obviously, dark blue is this portfolio, the subscribers portfolio, and light blue is the S&P 500. You've bought in at better valuations than the S&P 500. Most of your companies have a lower price to earnings ratio. Most of your companies have a better price to cash flow, right? You've done really, really well, and also you're getting a better dividend. That said, let's take a look at risk here now. Yahoo Finance rates your portfolio as moderately aggressive. I would rate your portfolio as extremely aggressive, given the lopsided plays into, high risk oil energy companies. You got really, really well placed and really, really lucky, obviously, on that one. And cryptocurrency. So, looking now at the heat map, over the last year, look what's done well for you. So what's done well for you is not gold and silver, right? Those commodities, those paper ETFs haven't done well for you. You're still doing well even now on the energy rebound. Bitcoin even still is doing pretty well. Bitcoin, both mining and generally. But interestingly, so is land and energy. This portfolio needs to get an identity. And what I mean by that is that it seems to be a three-pronged approach, right? So you're going inflation edge, hard assets, energy reopening, and also cryptocurrency. And all of those plays were excellent for the past year. Now I want to take a look at these holdings you still have, and I want you to ask yourself, what about the next year? What do I think is going to happen in the next year, or the next 2 years of investing? Because a lot of this portfolio I still think reflects an April of 2020 through like August of 2020 mindset, where you were betting on energy rebounding, large chain restaurants rebounding and eating up the market share. And a lot of that has done really well. But now ask yourself, with the obviously looming specter of inflation and other things, where do you want to be investing in? What sectors do you want to focus on? Because you've actually done pretty well picking individual stocks. I have to give you credit for that. Just based on the massive outperformance, you know your macros, right? You know your macro level investing. But the impression I get from this portfolio is that it's stuck in the past, right? So I don't see anything that's a really forward-looking play. So it might be time to take some of these winners, especially some of these huge concentrated investments, and put it into something you think that has a 1-year time horizon or even a 5-year time horizon. Things that you know in the future that are going to do better versus still doubling down on these reopening rebound plays. One great thing about looking at someone's portfolio is that you can tell their strategy just by the list of tickers they have. Just by these list of tickers, I can tell you're fighting inflation, you like cryptocurrency, and you're betting on a rebound in industries that don't get hype and don't get fun and coverage in the media, which has been energy and these large, boring chain restaurants. Congratulations, you've done very, very well. I'm just worried about how positioned this portfolio is for the future. I would like to see an addition of something that is a very forward-looking industry. I'd like to see some picks in that area. As for diversification, there are likely some people watching this video and screaming about how non-diversified this portfolio is. You know, that's really a call up to you, because obviously not being diversified, being concentrated has actually made your portfolio and given it the success it's seen so far. And, you know, here's the thing, too. The more you diversify, the more you become like an average portfolio, the more your portfolio starts to mimic the S&P 500. But my thoughts on this portfolio is that it's pretty concentrated. That could be a good thing. That could be a bad thing. And also, too, I would like to see more picks that are future-oriented into the next 2 years versus the last year. You did really well in 2020. Let's see you do really well in 2021, 2022. Okay, now this is what I would do if we literally changed places and I were handed this portfolio. Honestly, I would keep the cryptocurrency if this were me. The money you put into it, it's a very small cost basis. If you don't have a better place to put your money in the meantime, then keep the cryptocurrency. Even this blockchain explorer, this is a good stock idea. I don't know if it's worth $30,000 invested into it, but I do think it's a good idea. This company hasn't been around for a long time. It could outperform in the future. I could see it blowing up in popularity. Just the amount and concentration makes me nervous. I would still be invested in crypto mining as well as holding the currency. That two-pronged approach, really excellent. Moving on really quick to Ruth's Chris, the restaurant chain, Blooming Brands, the other restaurant chain, and also even too, I know it seems like you got a big relationship with this company, Crestwood Equity Partners. I think if this were me, they gotta go. These were some of the best places to be in 2020. I'm just not so sure now. Energy has done well, but you can find better energy companies that have managed to grow the revenues over the past years rather than lose it. I think too, restaurants have eaten up most of the growth they're gonna eat now. And this is a big if. If you have better ideas, better places to keep your money or to put your money, I would sell out of these. I mean, some of these are just hangers on. Like there's only $600 left in Blooming Brands. I would sell out of these and find a better longer-term 5-year time horizon stock and get into one of those. Portfolio is pretty small and pretty concentrated, but I would cut in half or split out of Blooming Brands. I would cut that completely. It's so small, it's not worth the emotional energy tracking this into your portfolio. I would cut this completely. Same thing with gold. I likely would cut that in half. It just hasn't performed, and I don't like these paper ETFs. If you love gold, then consider replacing it with physical gold. The physical gold price actually has increased the past year, whereas the ETFs, they're down. That tells you a lot. If you like commodities, then I think, if it were me, keep the same percentage in commodities, but I think you can find better commodities to put your money into. Specifically, some ideas that come to mind, probably the last few reopening plays that have real good potential in the future, is betting on the sheer pent-up demand and screaming desire for people to go back traveling. The tourist areas, when this is all finally over, are going to be flooded. And what's the best way to take advantage of your average normie traveler spending all their money on luxury goods and travel rather than saving up and investing? Well, it seems to me I would get some quality airlines. I mean, those always get bailed out. They never are allowed to fail. And Airbnb. Those are the two just at surface level I would consider looking at while investigating further down the road reopening plays rather than lingering and dwelling on natural gas energy and restaurants. So those are the 3 concrete changes I would make to that portfolio if it were handed to me today. That said, not financial advice. You know your position better than I do. You've done well for yourself so far. That's my reaction. That's my opinion on it. Alright, that's all for this portfolio review in this video. I want to thank the subscriber for sending in their portfolio and letting me take a look at it. This was a really interesting video. If you want to get your portfolio analyzed on the channel and get my thoughts and my critiques and my feedback, you can either send me a direct message on Twitter or send an email to eugenechargreen@protonmail.com. And what I want to see actually is just your full portfolio, your position amounts, just as much information as you can give me, the portfolio size, when you took the positions. I want to see all of it. And so what I will do is, in order to protect your anonymity, I'll reconstruct the portfolio on a different platform. No one will know who you are. And that way too, you'll get some feedback and also get to benefit from what other people are saying in the comments. I would love to make this into a bigger series where I review your portfolios and you get to see more ideas and what more people are doing. And that way too we can all benefit and learn more about how others are investing on the channel. So if you want to support this series, I encourage you, in fact I'm asking you, please send in your portfolios to the Twitter or the email account eugenechargreen@protonmail.com, and I'll do more portfolio reviews. That's all for this video, and I'll check you out in the next one.